Hi, welcome to the Personal Finance course. I'm Tom Mihawk, and welcome back for our chapter about mutual funds. Mutual funds are so important because so many people are investors in mutual funds. In your 401k plans, in your IRA, young people like the students that I teach, the undergraduates I teach, they'll be out of school soon, and the first investments they might make in their company 401k plans or in mutual funds. So it's really important to understand how they work and how you make money, what the taxation is. So let's jump in and talk about them. This is a wonderful slide by napkinfinance.com. It's meant to look like, somebody drawing a picture on a napkin. Of course, it's prepared professionally. But notice that what happens with a mutual fund is that investors pool together their assets and invest in a type of security. We would call it an asset class, stocks or bonds or something like that. And they pool their money in what we call a mutual fund. They invest in securities, stocks or bonds, for example, which generates returns which are then passed on to investors. And this grouping, this sort of, if you can think of it like a box around this investment, is what forms the mutual fund. An estimated 56 million households, or 44.5% of all U.S. households, own mutual funds. That's why it's so important, because so many people own them. The current estimate, assuming 2017, is that 100 million individuals own mutual funds. And you can see the increase here in this chart from about 5.5 million in 1998 to almost 19 trillion, I'm sorry, 5.5 trillion, sorry, to 18, almost 19 trillion in 2017. I can remember in 1991, 1992, 93, something like that, total mutual fund assets were 2 trillion, and we thought that was a lot. 2 trillion, can't believe it. Well, now it's 2017, 19 trillion just about. So they've grown incredibly. Why do we own mutual funds? Why are they so popular? So first of all, we get professional management. You know, my students that take the personal finance course are interested in this material. They read about it. They hopefully will take it with them as a knowledge that they keep for the rest of their lives. They use it if they're like me, and hopefully others of you that are watching this video. You're interested in this stuff. But nevertheless, you have a job. Maybe you're an engineer or a doctor or business executive or a nurse. And so even though you're interested in this stuff, you want someone else who does it all day long as their profession to make choices for you for your stocks and your bonds. Well, in a mutual fund, what you're getting is professional management. Next is diversification. It's not easy, it's not cost effective to buy the 25 or 35 or 500 securities it takes to have diversification. Studies these days say the minimum is, say, 25 or so, but most funds are going to have 100 or more. And so to do that is expensive. Well, a mutual fund for 300 to 500 to say $3,000, a minimum of 100 maybe dollars, for that minimum amount gets you the diversification that protects your assets. Affordable, as I just said, minimum for some $100. Typically between, say, $500 and $3,500, but minimum 100. Fund company transaction capabilities, being able to buy, being able to sell, transfer between funds with no cost. Systematic investing, so you can set your investing up to automatically reach into your savings account or your checking account, pull a certain amount every month. That's a great way to increase your investing amount, your emergency fund or your net worth. By pulling automatically, you won't miss it. Now, if you only make $1,000 a month and you're taking out 500, you'll miss that. But if you are taking out 500 a month and you make 5,000 a month, your lifestyle will adjust, you won't even miss it, and you'll accumulate assets quickly. Liquidity. You know, if you need liquidity, you go to your fund company and say, I want to redeem. They have to find a way to give you cash back. It's not as easy to do, for example, if you're an investor in a private company. It's not easy to get liquidity. Or if your primary asset is your home, You can't get liquidity right away, but a mutual fund gives you liquidity. There are many types of funds representing a variety of asset classes and purposes. Mutual funds are sold. They're built so that people will choose them. And so they're built, and not just people, but in institutions, professionals. And so they're built so that they cover important asset classes, valuable investment strategies, cover a variety of geographies of investment. And lastly, the performance that mutual funds produce is audited according to regulatory requirements. And so the 1 year, the 3 year, the 5 year, the 10-year performance that you see are audited, and they're produced according to regulations so that you can compare one to another. So you have apples to apples comparison. Lots of reasons. The primary two, professional management and diversification. Characteristics of mutual funds. Open-end funds are the kind that we know primarily. It would be as if a group of people put all of their assets together, divided by the number of people, divided the amount of the assets by the number of people, and that was the net asset value. It depends on the assets in the fund. The total fund's assets, less whatever liabilities there are, maybe some accounting or some fees, divided by the shares outstanding, represents the net asset value. Closed-end funds, by comparison, have shares that are issued that trade independent of the value of the underlying assets. When I first worked in investment banking, one of the first projects I worked on was for Lou Ranieri's Hyperion Total Return Fund. And it came out, its initial price was $10 a share. It invested in mortgage-backed securities, which Ranieri was, some say, the father of, was certainly instrumental in developing the mortgage-backed securities market. So it came out at $10. Well, guess what it sold at, this closed-end fund, on the first day of sales? $9.30. And guess why that 70-cent reduction? The 70 cents represented 7% on $10, and that was our fee. That was the investment banking fee we took. And investors knew that, so the share price automatically reflected it. It was independent of the value of the assets in the fund. And last, exchange traded funds. They've become very popular. Open-end and closed-end funds, typical mutual funds, price at 4:30 in the afternoon. They open at 9:30 at the market. They close at 4:30. There may be trading in those securities all night or over the night, through the night, but they open and close when the market opens and closes. Exchange traded funds price exactly when you make an order. If you buy at 11, market order, you get the price at 11. If you sell at 3, you get the price at 3. This is a great innovation for institutions, professionals, and for private individuals. Exchange traded funds have grown rapidly. They've accumulated a lot of assets, and in many exchange traded funds have very low fees too, and that's very attractive as well. So expenses of mutual funds. If you buy from an advisor, chances are you'll pay a load. There are load and no load funds. Loads have been as high as 8.5% historically. They're typically more likely between, say, 3 and 5. Many people that buy online, buy by phone, buy no load funds. In addition, mutual funds have different share classes, A, B, and C. A typically means a fee up front. B means no fee up front, but if you take your money out, if you withdraw in 3 years, 5 years, you might pay a deferred sales charge that declines depending on how long you leave the money. 3 years would be more, 7 years would be less, 10 years would be none, for example. And the C share charges an asset-based fee, much like a registered investment advisor or an RIA would charge you, an amount, say, every quarter based on assets under management. And the operating expenses, the expense ratio is a key measure of the costs of investing in a fund. Total fund costs over total fund assets. These costs include fees for management, distribution, marketing, and other costs. In typical funds might have an expense ratio between, say, 50 basis points and 75. That's 0.5% and 0.75%. The least expensive are these days 5 basis points. It's 0.05%. And some funds these days are offered for free by, say, Fidelity and Schwab. So expenses have been coming down a lot. And we know from looking at other chapters that keeping costs down on average is best for most investors. So, how do you make money with mutual funds? Well, when you sell the fund at a net asset value or a share price greater than what you purchased it at, this creates a capital gain. Now, know that the share price or the net asset value may vary from the underlying securities. If it's a bond fund, interest rate changes are going to change the prices of the bonds, but the fund managers may move the duration of the bonds, making them shorter or longer to take advantage of what they see in the bond markets, and that will affect the share price or the net asset value. Currency exchanges, if you have if stocks of international companies around, or U.S. domestic companies that have lots of international operations, currency exchanges can affect things. So you have to be careful when you're looking at mutual funds compared to the underlying securities, because the net asset value refers to the value of all the securities and all the other forms of profit that have been generated, such as dividend and income. Dividends and income increase the value of the assets in the portfolio also. Now, those are distributed to you, but they can increase the value of the assets in the portfolio. This is the end of the first section of the mutual funds chapter. Thanks for listening, and please come back for the second section.